transition of presentations. The first one was that there is no movement from, it's not a movement from philanthropy to impact investing. And then the other two showed that movement. So I guess, even though Paula is saying we should not be asking, is there a trade-off, there seems to be an overhang of that thought process still there. And, how do we answer that? How committed are we to impact measurement? Because I think that's something that's critical. And I want to point out the problem in Andhra Pradesh and call that out specifically, because earlier we said there should not be a trade-off. It should be commercial, and so charge whatever interest rates you wanted. And then when there was a negative rub-off, when there was media attention and political attention, and then interest rates were clamped down, people managed to survive in that interest rate. So why can't we institutionalize the impact measurement and the rigor? And I liked Paula's point about that, putting in the right rigor in the process. Are we able to be self-regulatory IIC/impact sector and really force ourselves to be committed to that rigor?
Rustin, question for you. Do you, and anybody who asks questions, if you can say if you want particular panelists to respond, or we'll invite anybody who wants to respond to. Okay. Paula, Devashish, Robert, who'd like to go?
Yeah, thanks, Royston. My comment on both existing and the future is really trying to address a theme that was more prevalent yesterday, which is that as things mature, one goes from philanthropy and leaves that behind to impact investing. That might be somebody's personal experience, but as a sector, as a world, we need both impact investing in the future because that's the massive money, and we need philanthropy because that'll sometimes make the difference between what won't go ahead and what will go ahead. So that's why I made that comment. I see both as necessary. My dream would be that both would grow.
Other questions? No, we have. I think we have. There's one there. Will.
So first of all, Paula, thank you for disagreeing with your former colleague. I wanted to do that, but I didn't have the courage. But I think the topic that we all need to, those of us that believe that there is in fact a ability to deliver market-based returns and impact, is how do we get the broader community to understand that and to get behind it, because we are going to unlock capital, to see capital flowing into all of the corners of the world where it is so grossly deficient and not going. We have to get the mainstream markets to understand that this in fact does work. And I think you make a great point that there are times when it makes sense to make concessionary returns, but because impact has that broad of a view, then people equate the two together. And they're saying, oh, well, it's concessionary, therefore we're not going to go there. So what can we do as an industry to help people understand what does profit first impact investing mean, market rate impact investing mean, and that you really have to demand of managers who promise that they deliver it. And just like you would if somebody's managing a mutual fund, investing in whatever, you can expect that they're going to deliver best in class. So do you have any thoughts on, is there language we should change? Are there ways that we can not keep polluting, if you will, our collective discussion that's going to, I think, chase away the mainstream capital that we so desperately need to flow?
Yeah, thank you. An excellent set of questions and a difficult one to address. So one of the things that we've been trying to push at Omidyar Network for a while is that kind of segmentation in the industry. So I can only speak for ourselves on the answer to that question. In our experience, when in emerging markets, when you have businesses that are serving lower middle income and above, mixed income, mass market businesses that are not capital intensive, in early stage, venture, you probably can have great returns. And if you have a fund that's paid up on that, you should hold that fund manager to that kind of returns. When you're serving lower income populations exclusively, when you have capital intensive businesses, that makes it more difficult, right? So that is our experience. We've come out and published about that. We need more people to make those kinds of distinctions, right, across different sectors and geographies, so that we actually have the data to say, look, here's where you should not relax any of your investing assumptions, and here's where you actually need to. And my greatest concern for the industry is that fund managers don't have the ability to be honest, and thus everyone is pitching commercial returns, even when some of them shouldn't be, and that could set us up for a correction, right? And so that's why we need to have this kind of distinction across the industry.
So
I've got another one.
okay.
So going to the philanthropic side, since it's called impact versus philanthropy, one question that many people that I work with in the philanthropics area in Seattle say is, well, is impact investing draining funds out of philanthropic coffers? And are my wonderful nonprofits that I've been supporting for years no longer going to be able to get the money that they need because all this money is being pointed towards impact? And so I guess, A, do we think that's the case or not? And B, is there any data that show whether that is the case or not? Or how might there be? I don't know who's best to answer that question because it's a hard one.
I can take a shot at just sort of sharing perspectives. I don't believe, there's any data that demonstrates this. And this is a question we've been asked often, and in fact, when we worked with IntelliCap late last year, early this year, to put out the report that all of you are seeing at your tables, this was a very big question of debate, that especially in the context of the Indian market, this came up in the context of the CSR legislation. Is there some degree of shift of resources? And there was apprehension, clearly, from the established social sector that this was going to happen, that impact investing was this new, exciting thing that would take away resources from a sector that clearly had much less than it needed. And I don't think that that debate has been sort of carried through to its natural end. I think it behooves all of us to talk about this as much as we can. From our perspective as a philanthropic entity, the MacArthur Foundation, very clear that these are absolutely sort of separate perspectives. Each one of the panelists talked about how particular social needs and particular circumstances demand or suggest the use of particular tools. So we absolutely don't see one supplanting the other, and in any given scenario there's only going to be either grants or investment or a combination thereof that's going to be appropriate. But I would say, just based on sort of the conversations we had with 40-odd people, 40-odd interviews for that report, this is something I think that this market needs to talk about very openly in the Indian context, especially as there are expectations that impact investing can and should grow phenomenally in South Asia. Okay. We have one more question on this side, and where's Ranjana? Okay.
Hello. So my question is I guess really with maybe most directed to Paula, and I want to preface my question by saying I completely agree with you actually about everything that you said. But my question is, when you're talking about making sub-commercial returns for industries that with the social impact is really worth it, what would you say to the argument that by investing sub-commercially, you're crowding out potential business models that will be commercially viable? How do you kind of address that concern?
No. Thank you. It isn't working now? No. Okay. So, and that's a great question. I also wanted to clarify that, many, if not most, of our for-profit investments at Omidyar Network do have commercial return horizons, right? So the Bs that I described are really the exception and stuff that we have great debate over. And one of the debates that comes up is that are you going to distort a market if you come in and do a sub-commercial, either give a grant, as in some cases, give a grant directly to a for-profit or have lower return expectations. And it's one we grapple with because I think it is possible to, in fact, distort a market and crowd out commercial capital. But often, and so we try to avoid, for example, picking a winner. Like we believe really strongly with subsidy, we believe really strongly that you need to preserve competition, and that's the only way that you're going to make prices cheaper for customers and grow the market. So we don't, directly give grants to for-profits for that purpose. But we also believe in a lot of in the markets that we're investing in, it's like sometimes there's no market to distort yet. And I think that's something we have to get to terms with as an industry, that if you're, giving a PRI to a really early player in the market, it's, sometimes there's actually no competition yet to crowd out. And in fact, when competition emerges, we should embrace that and let the market then develop on its own. Yeah, that's actually it is a great example. So one of the, I should say, best loved and often used examples in the industry, so people may groan when I bring it up, which is Bridges International Academies, right? So this is a private school chain in Africa that operates, started out in the slums of Nairobi, very low cost, sort of modular education that could be replicated very easily through its business model. And we started out, it was a PRI for us. It was, we knew that the risks involved in that business context were really, really high. And that was not our primary motive, was not making commercial returns. Over the years, as that business model has gotten de-risked, we've moved it out of our PRI pot into the, not to get too technical, but into the endowment where we expect sort of higher returns, commercial returns. And we've seen now, we've seen a number of commercial players come in, and it's that type of trajectory that is actually exactly what we're hoping for. And so in that case, coming in with more patient capital is enabling the de-risking of a business model, which can then go to scale.
Thank you. Do you have more questions? Or I think we've run out of time anyway. So thank you, everybody. Thank you to the panelists. We hope to carry on this conversation beyond today with many of you, and look forward to the rest of the afternoon. Thank you.
We'll take a short 15-minute break, and I'd request you all to, please carry your cups inside so that we can start the next session within 15 minutes. So it's 2:35 right now, so we'll start the next session at 2:50. Thank you. Good afternoon, everyone. So are we all settled? So can we just please take our seats? We are about to start for our next session. Okay, we're starting with our next plenary. Market return versus muted return, to each his own. So Geeta Goyal will be the moderator for this session, and I think we'll be starting within a minute for this session. Geeta is responsible for leading Michael and Susan Dell Foundation's global mission investing function in the role of a director. And prior to this, Geeta led the foundation's family economic stability initiatives. Geeta has been on the research committee and on the board of IIC as well. And IIC thanks Geeta for joining us today and welcomes her on stage to share her insights on this topic and to take the discussion ahead. Over to you, Geeta.
Okay, it's on. Okay, welcome to this post-lunch, pre-coffee or post-coffee session. And clearly we can see we had a very interesting discussion in the panel before us. Before we jump into this, which is again a very interesting topic, muted return versus market returns in impact investing, I just wanted to see which is the word or the term that you've heard the most in the last 2 days that you've been here. Impact. Yes, exactly. Good. So yes, I was just thinking we've heard so much about impact that, and not surprisingly we are here at an impact investing conference, but I think it's time to switch gears and to look at returns. You know, I mean, after all, it's about investing. It is about getting funds back. So what is the focus on returns for an impact investor? You know, and again, I think it starts this endless debate of muted returns or market returns, finance first or impact first, what is good, what is bad, what does the industry need? And I think, I mean, I've been in this industry for 10 years. I've heard this debate at every workshop, every conference, every article, and we still do not have consensus. So we will not have consensus today. I can promise you that. But I think at the cost of maybe making Amit and Ranjana a bit angry, I would say maybe we've framed the question incorrectly for this session. It's not muted returns versus market returns. I really think because impact investing is not one asset class. I mean, so if we are comparing across different asset classes, which range from, you know, high risk seed equity to collateralized debt to growth capital or venture debt somewhere in the middle, I mean, why are we comparing returns across that spectrum? And you know, I mean, it's really sort of trying to do disservice to maybe what each of us are doing. And in that light, I would really like to propose that maybe it's time we shift the discussion to saying what are the different asset classes within impact investing, where each of us are on that spectrum. And then try and see if, you know, there are comparisons possible. And just to illustrate that point, maybe I'll take a quick example. Okay, I see the watch. I'll take a quick example of a conversation I had last week in Mumbai with this friend of mine whom I met maybe after 15 years. We were together at business school. He happens to be now, he manages investments for one of the leading insurance companies in India. So he was saying, you know, he manages a portfolio of $15 billion. What his investors are looking for, safe returns and yet maximum returns. And interestingly, he said, okay, you know, we do a little bit of unlisted securities as well, and the quantum there also was much larger than what the foundation can ever think of, given that, you know, his total portfolio is 15 billion. But we found that there was one sector where he had also heavily invested and we had also heavily invested, and there were 3 investments in common. And, you know, I said, like, you're trying to maximize returns and, you know, yet provide safe returns. On the other hand, the capital provider for me is trying to maximize impact. So, you know, either of us are doing something wrong if you're investing in the same companies. But really, I think when we invested in these companies, that was way back in 2006, and we have Samit here. At that time, I think Devashish said in the last panel, urban microfinance was non-existent. Based on our experience globally, we felt, you know, it could work in India. We could have role models and we could invite commercial capital. So we went ahead and put in high-risk seed capital in 8 companies between 2006 and 2009. And frankly, at that time, none of these mainstream investors were looking at these companies. I mean, they felt urban microfinance was just too high risk. So we went ahead and took that bet. Again, with the objective that we can catalyze the market, we can bring in new investors. And over a period of time, these companies delivered scale. they delivered profitability, and that's when, you know, people like insurance companies and all started investing in it. So I think what he's doing is impact investing because it's impacting the same set of clients that we wanted to impact. And clearly, I believe what we did was impact investing, but the returns, the risk profile of assets is so very different. And I would just say that we are on two ends of the spectrum, and that's what we need to recognize. And I think it's time we start creating not silos, but identifying the different groups in that spectrum. So I'll pause on that. Sorry, this watch is a little bit distracting. It keeps showing different numbers. But I'll pause on that and invite the speakers here. I'll introduce them one by one, just so that you remember who's speaking. So the first one, Adam Wolfenson. Just a very quick introduction. Adam is the co-managing partner of Encourage Capital. And Encourage was set up in 2015 with the merger of Wolfenson Fund Management and Echo Asset Management. Adam's family was the initial co-sponsor for both Wolfenson Fund as well as Echo Asset Management Company. They've done several investments, some which in the traditional sense will qualify as impact investments, some may not. And I will not go into the return definition there. But they have also done investments in India, and I think 2007 was the first investment that you did in India, in Fab India. And, and then, thereafter many others in financial inclusion. So, Adam, over to you.
Hi, go here. Thanks very much. Excuse me, and thank you, Geeta. Thank you for being here, and thank you to the conclave for having me. My name's Adam Wolfenson, as Geeta said, co-managing partner of Encourage Capital. And our current focus areas do continue to include financial inclusion, forest carbon, and sustainable fisheries. We've been investing in India since 2007, and our current and past portfolio companies include Fab India, where we were the first outside capital, Ujjivan, and we'll hear from Samit later today, or later on this panel, DCB Bank, and also Repco Home Finance. Now, these companies are fully commercial business models. They're very impactful, and our investments in them were very meaningful and impactful to the companies. Now, let me turn to the framing question of muted returns or market returns. We do need to, I think, start with a few core principles and, unfortunately, define impact investment because I think that's the